Hey there, Ken Calcutt with Cornerstone Financial Management. Coming to you here in early December. Wanted to give you a market update. It's probably been a month since we've done one of these. Not a ton has happened since our last update. This is the chart we typically look at, just showing the S&P 500 stock market movement for the better part of a little over a year. So this was the drop we saw in the spring when the tariffs were first announced, and then we've had this huge rally from April. We kind of peaked here in October. And then since early October to where we are today, it's early December, just kind of been floundering a little bit, not a whole lot of movement in the market. Generally, it's been a good year. It's been a crazy year, but the market is up, give or take 15%. It's been a solid year. Where we're at today going forward, so some of the key things that are probably impacting what we're seeing. The Fed has a rate cut decision actually today. So by the time we get this posted, that will have already occurred, but they're making the decision later today if they're cutting rates again. The market is already, this little rally right here, I believe has occurred because the market has assumed a rate cut is coming today, and that's typically good for the market, so we're going to see a little bit of a rally. If a rate cut does not occur, I fully suspect we're going to see this sell off today and probably for a handful of days, because the market has already priced in the cut. But regardless of what happens today, I think we are generally in a rate cutting environment. I think we'll see more cuts over the next 12, 18 months. And that's generally good for stock market most of the time, but this is a little bit complicated. So a few things that I think are worth keeping an eye on for those of you who like to follow it. The Fed is in this predicament of managing the interest rates while they're trying to balance the inflation problem that we had several years ago and the labor market problem. And that's really the dynamics that the Fed is trying to balance. They want inflation low, which our last reading was 0.2% month over month. I think it was 3% year over year. They want it at 2%, so they're not quite as low as they want it to be, but they're also concerned that the labor market is weakening a little bit. I'm not sure that's accurate, because we have delayed information from the government shutdown. We don't have all the labor information for the last 2 months. It's coming in pieces. So we have very murky information on the labor market, where the inflation data we think is pretty reliable. It's in the mid-2s probably. So for them to get inflation lower, they would likely not want to cut interest rates anymore, because if they cut rates, that re-stimulates the economy, potentially causing inflation to go higher. They don't want that. But if the labor market is getting weaker, they may cut rates to stimulate the economy to help the labor market. So it's a tricky dynamic for them, where they may help one side of the equation, they may hurt the other. And that's why you have so many different opinions on whether they should cut rates or not. It just depends on what's happening with labor market, what's happening with inflation, and everybody seems to have a different interpretation of that data. But regardless, I wouldn't want the job of the Fed. It's a tricky one right now. I do think the general path of interest rates is probably lower for the next 12 or 18 months. Another dynamic to that, the Fed President, Powell, his term is up in May. They're already talking about who Trump's going to appoint for the next Fed president. Likely going to be someone that's more accommodative to Trump policy, more interest rate cutting, which is what Trump wants. Not to say that's the right thing, but that's the direction Trump wants it to go. He's going to put someone in place that probably agrees with that. So then you have this dilemma of, well, are they going to be cutting rates too much, which could cause inflation to go back up again? That's causing a little bit of fear in the bond market, I think, because people are looking that far out. So that's only 6 months away. So anyway, there's all these moving parts with why the market's doing what it's doing. I still think interest rates are an underlying component. Another component that's worth noting is technology. We've heard all the talk about AI. AI is here to stay. Right or wrong, good or bad, it's here to stay. So many companies are using AI now. So many companies are involved in developing AI. It's been the main catalyst for this entire run, really going all the way back to 2023. It has generated significant profits for a lot of companies. The debate is, are the stocks too high for the profits these companies are making? And it's debatable. For some companies, they are overpriced. For others, not so much. So I think we'll continue to see some choppiness like this in the market. This doesn't look like much, but this is like a 5% drop that happened in a couple of weeks. So noticeable drop and then a quick recovery. These are pretty significant moves. I think we'll continue to see this kind of choppiness because of the dilemma between the companies that are actually profitable with AI and the ones that are just losing money. And so that's going to take time to play out. I do think generally technology and AI will be beneficial at pushing the market higher, but I don't think it's a straight line. I think it's going to be a choppy line. So the overall outlook, I'm generally optimistic about. I think interest rates going lower is probably a good thing. I think technology companies' profits will continue to grow. I think everybody else's profits, if they're using AI appropriately, could also improve and grow. And if those profits are growing, then the stocks are growing. So that typically is what we would expect to see here. So it's a complex market, it always is, but those are the dynamics that I think are driving all of this. Interest rates and technology, I think both are generally favorable, and I think we'll continue to see good growth into next year, assuming no curveballs get thrown at us. But we'll just wait and see. We'll take it 1 month at a time. Hopefully this is helpful for you. If you have any questions for us, as always, reach out anytime. Thank you.